from wherever you are joining from, and thank you for making the effort to join tonight's webinar, organized by Jada Fund of Funds, a subsidiary of the PIF, in conjunction with MSCI. My name is Vishal Patel, and I manage the MSCI Analytics business across MENA, and will be your host tonight. Now, as we witnessed the dramatic opening of the kingdom, the Saudi government, as part of the Saudi 2030 vision, have been seeking to grow the economy in an extremely prudent manner. Subsequently, there has been a particular focus on venture capital and private equity assets. And for this reason, tonight's webinar will focus on how venture capital and private equity investments are taking place within the region and how investors can measure the appropriate level of risk on such investments. Through the course of the evening, we hope you will gain an understanding of how asset owners such as Jada Fund of Funds and their asset managers make sound investment decisions, how they measure the risk of their investments. For now, I am pleased to introduce you to Mr. Adel Al-Atiq, the CEO of Jada Fund of Funds, who will be walking you through the first session of the evening and will discuss the birth of Jada. Mr. Al-Atiq, over to you.
Good evening. Thank you, Vishal. Thank you for joining us as MSCI in this important event. And I also thank the team at Jada, Lisandro and Adari and Riham, and also Abdullah and Sonia. We're happy to kickstart a discussion on risk management in the private equity industry. As you know, Jada has been established a little bit over 3 years now by the PIF with the aim of help thriving public or private markets, especially in venture capital and private equity funds. As you know, Saudi Arabia has a very strong asset management industry or investment management industry when it comes to public markets. But when it came to private market, we did not have a strong private market. We did not have lots of investment managers focusing on venture capital or private equity growth markets. So Jada was created to help create this industry, to help it grow, to help grow the economy of Saudi Arabia. Obviously, today, since we started, so far we've invested in more than 20 funds. We've already committed close to 2 billion riyal in those 20 funds, and we continue to invest and commit to both venture capital and private equity funds in Saudi.
That's fantastic. Thank you, Mr. Al-Atiq, for the insights into Jada and how venture capital investments are perceived in the kingdom. As we move into the next session, I'm pleased to introduce Sam Prabhu, who is the head of technical sales across EMEA for MSCI. He will walk us through how MSCI's proprietary private equity model can be used to calculate private equity risk. Over to you, Sam.
All right, thank you, Vishal. Thank you for having me on this very interesting event. Just as a bit of a background along the lines of what was mentioned by Mr. Al-Atiq, what we have seen in collaborating with various investors in the kingdom and broadly in the Middle East is this increased focus on private assets and the increasing sophistication. I've been working with clients in the region I've been with MSCI now 17 years. I've been working with clients in the region for a number of years, but the sudden increase in sophistication and the local investment makes it a very interesting time that offers a lot of opportunity for investors and companies like MSCI, for example, to support them. Right? So what I'm here to talk about is what do we provide that helps investors and risk managers like Alessandro to analyze the portfolios, and how do we facilitate the communication that happens. There are two levels of communication that happens. One, from an investing entity, and in this case, it could be the PIF or it could be any other investing entity that decides to allocate capital to an investment management firm, and our tools facilitate that communication, right? So when they look at their the asset owner, be it a sovereign wealth or pension plan, when they look at their portfolio and decide how much to allocate to private asset classes, how much should we take from public assets to private assets, that is the starting place of this decision. Once that decision is in place, then you have the secondary decision. Okay, now the capital is in an asset management firm that manages private assets. Then how do we facilitate the communication between the sources of risk and the sources of return? And how does the middle office talk to the front office? And how does it improve the overall governance in what is, as was mentioned, a evolving industry? Okay, so at the heart of what MSCI brings to that problem is a multi-asset class model that a sovereign wealth institution or a pension plan that looks to invest in this can use to identify how much am I allocating and why am I allocating to a specific manager. That question is answered using our multi-asset class model. Okay, so but then once it comes to a firm that is managing the assets like Jada, then the focus on the broader asset classes is less so, but it is important to understand the relationships. So this multi-asset class risk model that encompasses private asset classes, links it to public asset classes, serves a very important function of telling what is the diversification that one is obtaining for the illiquidity premium at the investor level. Once we define that, then comes the next question: what is the relationship between the assets that a firm has invested in and the public markets? Third question: what are the private factors that I'm exposed to, and what is happening in the industry around me? What is very unique about what's happening in the kingdom right now, unlike what I see in other parts of Europe and certainly around the Middle East, is this extreme emphasis on governance and this understanding of systematic drivers as it folds into the private investment structure. What we see typically in say in continental Europe, for example, you have private asset managers who are interested in their assets. They talk about the value of the assets, and they're very much focused on the individual asset itself. Whereas what we see in the kingdom very much systematically is that emphasis on governance, that the front and the middle office are talking to each other, and there is an observation on and a focus on the systematic drivers of risk and return. Okay, so that's the broad template under which MSCI supports it. Within that broad template, on the next slide, when you look at, so you can talk about what do we do with private asset classes. Okay. So private asset classes composed of sort of private real estate, private equity, infrastructure, farmland, timberland, however you define the private debt, for example, however you define that. Problem number one is, where does the data come from and what level of granularity is the data available? So this problem, in the case, in certain cases, clients have the data very rarely, right? Clients provide the data. Routinely, what we find is that data doesn't exist with clients. They tend to go to other providers like Burgess or MSCI Real Estate. And so we have facilitated that data that is essential for modeling, that is the basic data that is essential for modeling, to be sourced from upstream vendors. That solves the data problem. Once you have that minimum amount of data model, then you come up with the question of, okay, for a risk manager, maybe the top level drivers of risk are sufficient, but for an investment manager, that top level risk is not sufficient. They want to know, look, I've invested in a particular venture capital fund, venture capital asset, and I'm invested in another venture capital asset. There's a clear reason why I'm investing in asset A and asset B. And they want that specific information to be incorporated in the analysis. Otherwise, this communication between the front office and the middle office doesn't happen. One needs to clearly define why, what is unique about the asset. At the same time, one also needs to define specifically, what are the systematic drivers. This data typically needs to come from the client, and that's extremely important. Once the data is there, then comes the sort of the art/science of modeling the investment. Typically, what we are seeing, especially in the kingdom, a lot of the investments are local investments. So finding global comparables is very, very difficult. They are meant to facilitate the local ecosystem, economic ecosystem, and therefore they tend to sort of be very global exact comparables are very difficult to find, right? So that's kind of the backdrop within which we are trying to solve the problem of governance and risk and investment within a venture capital setup. Okay. On the next slide, right, what we want to say is, okay, how do we solve this problem, right? What are we trying to solve for? What we're trying to solve for is a way for us to, when you look at private assets, ventures, biotech ventures or any tech ventures, for example, what you find within this is there is a lot of smoothing of the returns. The quarterly returns typically marginally different from previous quarter returns. The first value add that MSCI brings is to identify what is the de-smoothed return of a particular type of investment, be it private equity, late stage ventures, early stage ventures, buyouts, whatever they may be, defining what is the de-smoothed return. Then the second value add that MSCI provides is the ability to separate the public asset class from the private asset classes. What is the return coming from purely private factors, and what is the return coming from the public factors? Now, a lot of private managers tend to think that the all of the return comes from purely private, but that's not the case, right? We all know that. There might be a lagged effect, but there is certainly an effect, and MSCI helps separate the two pieces together, right? And that's the crux of what MSCI brings about. On the next slide, right? So as we just summarizing the requirements here, right? Firstly, we need to be consistent between the risk front office and the middle office. In order for that front office, middle office communication to happen, there needs to be a relationship between broad systematic factors and asset specific factors. Thirdly, the very MENA country focused investment strategy requires a slightly different approach that one doesn't need to do if you're modeling sort of what's in Sandhill venture capital firms. You tend to find more global comparables, but the local ecosystem means one needs to be careful about it. Thirdly, without asset specific data being provided by the client, this problem remains sort of not fully solved, if you will. Okay, those are the four sort of summarizing requirements based on just on what we've seen. On the next slide, right? So what does it mean? So when we work with Alessandro to sort of say how do we help solve this problem of governance and how do we solve that? I think the first thing that we observed was there are a lot of small and medium enterprises that for which the global comparable just doesn't fit exactly. There are many global comparables, and finding the right fit for that has both high level information and detailed information is very, very difficult. Okay. Secondly, what we found, what we needed to do was there was a lot of asset specific information that was available. How do we use it, and how do we not over engineer this problem, but use it in the context of helping the communication and the risk management? So how do we take the financials of these firms? How do we translate that into a factor language? How do we enable the comparison of company A investment and company B investment? That is by using individual company specific information that was enhancing the modeling. Okay. The third layer was, we can, just because comparables are hard to find doesn't mean we shouldn't find them, right? So once we started using the factors, then we were able to cover a majority of the exposures, and then for what was left, we used comparables. So here, the big innovation that we've done in respect to modeling the risk of these assets is using the public factors, public market factors, using the asset specific factor information that reduces the dependence on comparables for early stage companies. And lastly, just using comparables as well to enhance the granularity of the information that we have about an asset. Okay. Once you have all of these pieces together, Then when you go to the next slide, this is a sample investment and the decomposition of a sample asset. So here I'm looking at the risk of a specific asset. For this specific asset, I'm defining, this is, in this case, is an example which I use a European private equity fund. And so this has high correlation to European late stage ventures, and we define that. Then we define sort of which country exposure it has, what kind of style exposures that we have. This is derived using fundamental data about the company. And then we say, okay, what kind of industry are you investing in? So you have a private beta that links you to the public market. You have the asset-specific risk that is derived from asset-specific details. You have public factors and you have purely private factors. This combination that we created is what then goes as an input into the risk management process that then helps you govern and monitor and look at what is driving the risk of this asset and consequently the portfolio as a whole. And that's what we are trying to estimate as a part of the process. So I just wanted to sort of summarize this by saying that when we look at these assets, it is really important to combine the private asset information, the public asset information, the purely private factors and purely public factors all put together by using comparables to make this analysis relevant and applicable for the governance of a firm like Jada. That's kind of the summary, and Alessandro can explain how that happens in reality, and we can go more in detail in the next session. Back to you, Vishal.
That's fantastic. Thank you very much for that overview, Sam. And then we can now swiftly hand it over to Alessandro Giasanti, who is the head of risk at Jada, and who's going to be demonstrating how the MSCI private equity model was actually used in practice and how Jada tackle measuring private equity and venture capital risk. Alessandro, over to you.
Thanks a lot, Visha. Thanks a lot. And as you said, I will discuss about what is the risk framework that we are implementing in Jada. And I will go in detail all of the different type of measure and all the different type of building block that we use in Jada to have a holistic assessment of the risk of our investment. And you can see from this slide that we are using 3 building blocks for the estimate of the risk of our portfolio. The first building block, we call it as investment risk, which is the result of the investment due diligence analysis that is executed by our internal investment team when they decided to invest in a third-party venture capital or private equity fund. So they do their own analysis, they look at the structure of the investment team, they look at their experience, their performance, their type of investment, the strategy they want to implement, and they come with a scorecard which summarize the risk that they have identified during the detailed and the deep due diligence analysis. So this is the first building block that we use when we come with a comprehensive scorecard for our underlying investment. Second building block, we call it operational risk. And actually it's a result of operational due diligence that we execute in-house on our fund. And we see with a type of due diligence that looks at all the type of component of our investment which have not been covered by the investment. So everything that is not investment related. And we will go more in details in the next slide. So as a result of this operational due diligence, we provide a scorecard that will contribute as a second building block to the estimate of our risk. And sorry, if you go back to the slide, just to show we have a third building block, we call it a portfolio risk. This building block is basically an estimate of the market risk of our portfolio using the analytics of MSCI Barra, using the MSCI private equity model as was previously identified and explained detailed by Sam. So these 3 building blocks, we assign 1/3 weight to each, and we use it to come to overall assessment scorecard of the risk of our underlying investment. Now we will focus in the next slide on the operational risk and the portfolio risk, which is the part that is more under the analysis of the risk compliance team. So in this slide, we go in details on the assessment that we do after our operational due diligence. And we can see that we are using a number of what we call a core factor. Actually, we have around 12 core factors, which look at different area of the investment management company, which is managing the fund, our underlying fund. So we look at governance, human capital, regulation compliance, valuation, down to third-party relationship. Overall, this is a quite generic type of area that can be applied to different asset class, but we assign a specific weight. When we look at the weight, we try to look at a peculiarity of our asset class, specifically private equity and venture capital, and we see what are the components that we believe can be more important for this specific asset class. Indeed, we give high weight to valuation, methodology, and process, which we believe specifically for venture capital, private equity is very important area that we should focus. Cash management, accounting and reporting, regulation, compliance, audit, and the human capital. We are in a human business, so it's very important assess that our investment, the human capital, our investment is properly managed. And we assign this 12.5% weight. Then we have a lower weight for other component, which we believe are a bit less important for this asset class. We assign a score to each core factor. Score goes from 1 to 5, where 1 means deficiency and 5 means best practice. And we come with an average weighted score, which in our analysis summarize what is identified as operational risk of the fund. Now, what I want to say that in Jada, we do several investment in a first-time manager. So manager that company that are investing for the first or second time. So we see that probably a situation where they don't have a very well-defined, structured organization. And the role of Jada in this case is to work together with the fund manager to, once we identified what we call findings or deficiency, and we have a different classification from high risk to medium and low risk. We work together with the investment management company, with the fund manager to define a path and over time to close with this gap that we have identified. We monitor over time. So really to help, as we see also the companies growing in terms of people, in terms of structure. So we try to work together to close what specifically the gap that we have identified with the high risk. So we are in a situation that the operational risk of our investment will decline over time. Now, this is the second building block. In the next slide, we will focus more on the last building block. So the block that we identified as we call as portfolio risk. And this is the block that where we leverage MSCI bar. You can see from this table, from the top of the table, that we come with the analytics as an output of our risk system. And this analytics use the risk factor of BARA, which go from market risk to industry specific currency risk. And we look in details also the contribution to this risk from each fund. Well, one thing to say that we invest in one asset class. Our portfolio is not a multi-asset portfolio, so it's very polarized in venture capital, private equity. So we can have a situation where the system identified with the private equity risk, you can see that can become very, I would say, predominant and overwhelming compared to other risks. And at the same time, it will not give so much added value information, because we will not be able to really differentiate between one fund to another, while they will be quite aligned as being all invested in venture capital in terms of risk. So what we want to focus more is some risk factor that they will give us more information, more value in terms of differentiate the different funds. And we focus more on specific risk, industry risk. You can see also from the graphic of the slide that we have assessed the specific risk of the portfolio is 4.7%, which was quite a substantial reduction of the specific risk, which we find in, for instance, in Fund 1 and Fund 3 at double digit, which is an indication that we are starting to see important diversification effect in our portfolio. That will give us valuable information. At the same time, we're getting valuable information from contribution to specific risk and industry risk coming from each underlying fund. You can see from Fund 1, for instance, despite having a market weight of 25.9%, the contribution of specific risk is quite high, around 50. This is also a situation that our portfolio is not in a very mature stage, so we can have initially some fund that we have a high contribution, but it's important for us to monitor over time and to make sure that over time, as our portfolio becomes more diversified also in underlying funds, this contribution is not so much polarized on a single fund. Now, in the next slide, there is additional information that is valuable for us from the analytics of the system, where we look at the contribution to specific risk. And now we dig at a lower level. We don't stop at the fund, we go to the underlying company level. Because when we import our portfolio, we import at single company level. We see that we don't look at the market weight, but we look at the contribution to specific risk coming from any single underlying company. Because as probably many know, looking just at market weight can be misleading, because you're missing important information like the volatility and the covariance contribution to the total overall risk from different companies. For us, it's important because in our portfolio, we can have situation of overlap. Some funds, more than one funds invest in the same company, given that our regional focus is not international, but is mainly focused on Saudi and GCC. So we want to avoid a situation where at portfolio level, we have too much exposure to any single company. So now this is current situation, we have some company, for instance, where we reach 20%, which is a level that is still, we think, is manageable, but we don't want to go beyond. So it's important to us to monitor what is the contribution really coming from any specific company, specifically when we look at specific risk and idiosyncratic risk of the company. Next slide, we also look at different risk factor, different angle. We look at the country. Given that our important mission of Jada is to focus on Saudi Arabia and GCC, but predominantly on Saudi Arabia, we want to make sure that Saudi Arabia is an important source of risk of portfolio, and we don't have an intended situation where the biggest source of risk comes from a country where we're not expecting. So from the analysis here, we compare the market weight with the contribution to specific risk and contribution to industry risk from different countries. You can see that Saudi Arabia, despite having a weight around 35%, in terms of contribution to specific and most importantly industry risk, is having a predominant part in our portfolio, which is in alignment with our objective and our mission. Next slide, I will show also what we look at in terms of industry. And in this case, we have a GICS classification of a global industry, and we compare market weight with the contribution to industry risk. we can see that as expected, given that our portfolio as current stages for large parties invested in venture capital fund with a large exposure to information technology. Our portfolio is, in terms of contribution to overall industry risk, is coming from predominantly from the information technology sector. But we expect over time, as we increase our allocation to private equity, to growth capital, that this exposure to information technology should decline, should go to a more lower level. However, this information is also valuable for us because we don't stop all of the market weight. We really look at what's in terms of risk weight, where it's coming from the industry in our portfolio. And all this type of analytics, then we combine in a scorecard. And if you can see from next slide, we come with a scorecard also for portfolio risk at fund level. So basically it helped us to have identification what is the level that we identify in a risk on a fund based on the analytics of our risk system. We have so far selected 4 different metrics where we look at the total risk of an underlying funds. We look at the specific risk concentration. We look at industry risk concentration. We invest in funds as expected, specifically venture capital fund. We expect to be highly concentrated, but it's also important for us to monitor and it also to assess one fund versus the other in terms of what's the real concentration to specific risk in their portfolio, and also concentration to industry risk. And lastly, anytime we include a new fund in the portfolio, it's very important to us assessing, monitoring what will be the impact, the additions to the total risk, what will be the contribution coming from this single fund. So overall, we have equal weight to one of these 4 components. We come with an average score that we combined with the other 2 building blocks. The score here goes from 1 to 5, and the 1 will be classified very high risk, and the 5 low risk. And so this is in a nutshell what is our approach in looking at the risk of underlying fund. So as I mentioned before, we have 3 different building blocks. We also a teamwork within Jada. So the first building block is a risk that is identified from the investment team during the due diligence. And then there are 2 building blocks is a cooperation with the risk team where we look at other angles. We don't look at the investment side, or we look at the operation side, and we look also what is the impact on the overall portfolio. So given that, as mentioned, we have a situation that we have some fund that invests in similar companies. It's important for us that we look really holistically, and we look at every single underlying exposure to our in our portfolio to startup to other companies. So that is the overall analysis of the risk framework in Jada.
That's fantastic. Thank you for highlighting the building blocks in your risk methodology and the risks associated with your investments, Alessandro. So now, moving from the asset owners, we're moving on to a panel Q&A with 2 asset managers who actually focus specifically on private equity and venture capital investments. We're joined by Sonia Sef-Gokal, who's a co-founder and general partner at Ventrue, and Abdulaziz Al-Tamami, founding partner and CEO of Merit Capital. Thank you both for joining with us, Abdullah and Sonia. It would be lovely if you could spend maybe a couple of minutes introducing yourselves so that the audience can learn a little bit about your backgrounds. Perhaps, Sonia, you could go first.
Absolutely. Thank you. First of all, thank you very much for having me here on this session. Thank you to the Jada team for inviting me to join. I really appreciate it. So my name is Sonia Gokal. I'm one of the co-founders and general partners of Ventrue. We are a Middle East-based early stage VC with a focus on fintech. I myself am Canadian born and raised. I'm an actuary. I'm a fellow of the Society of Actuaries in the US. So risk is part of my training. Prior to Ventrue, I worked for one of the sovereign wealth funds in Abu Dhabi in their special situations group. After which I started Ventrue with my partners.
Thank you so much. And Abdullah, be great to learn a little bit about yourself as well.
Yeah, thank you, Vishal, and thank you everyone and the attendees, and thank you to Jada MSCI for the event. So Abdullah Al-Tamami, basically founding partner and CEO of Meetup Capital. Before Meetup, let me introduce Meetup first, and then maybe get a little bit about myself. Meetup is a technology investor. That's how we like to introduce ourselves. We do venture capital as well as private equity, and now expanding further into other alternative asset classes. But mainly we do alternatives and private capital. We focus, we're industry agnostic, but regionally when it comes to private equity and venture capital, we focus in the MENA region, primarily Saudi and the other countries on a secondary basis. When we look at more international transactions, we rather work through partnerships and other potential partners in those areas. Myself, I come from a background of investment and technology, as well as entrepreneurial background. I was part of founding a payment company before called Hyperpay, and then during that time also established a VC fund managed by myself and my colleagues at that time that did quite well at that time. And from that, building Meetup with my other partners, running the firm today, and expanding into technology investments.
That's fantastic. Thank you very much. And given the fact that you both focus on startups and new ventures, often these companies have very little history and generally high level of operating costs. So, I mean, how would you manage the investment risks of such companies in your portfolios? Perhaps, Abdullah, you could give us some insight on that first.
Sure. It could be a lot of risks that we can really delve into. But I liked how the breakdown was earlier explained by Alessandro as well as Sam. I think the way we'll look at it initially, we'll look at the investments that we invest in the companies that we approach, and how we deal source or build our pipeline of companies, whether we're talking about venture capital or private equity. We try to be quite disciplined. I think maybe also what's going on now on a macro and more specific level in the world in technology is also related to this. We try to be disciplined when it comes to a lot of things to manage our risks. One is how we approach companies in terms of valuation, in terms of how they are valued in the private market. We rely a lot on public comps, whether locally or internationally, and also regionally. We segment them that way. So when we do the comps, we do country level. So we have public companies now growing, technology public companies in Saudi, still small to where it should be, but hopefully it's getting there. Regionally, we have companies that can be compared to some extent, publicly speaking. And then we have international comps. And then you have to weight each one and see how much of a discount that you have to factor in. And always kind of try to be more towards value and quality of pipeline that you're going to execute on, rather than trying to ride a certain wave that might not necessarily last for the term of the fund, which we have to keep in mind. One of the things that we also do on an operational level is maintain a constant yet somewhat but not very dynamic strategy across the fund. You cannot midway start changing your strategy that you put in place. You got to think long term, especially since these asset classes, specifically venture capital, go on for 10 years plus minus, depending on the region and the strategy. So getting into the details of investment risk and pipeline building, trying to be disciplined, trying to focus on companies that you can add value, having a way forward. One of the things we do is we like where the public markets are going today in Saudi, so we kind of target towards that in terms of an exit. If we were able, so one of the disciplines that we follow to mitigate risk. We tend to shy away a little bit from companies that have a target of exit value purely on M&A, given our insights that we were able to kind of unearth through our research, we tend to focus more on publicly or listable companies that can be listed in Saudi, which mitigates our exit risk when it comes to trying to get to that return to our investors. And then operationally, obviously, we try to follow best practices in establishing our funds. Mirak, after all, is a licensed entity. We are regulated by the Capital Market Authority of Saudi Arabia, and we are very proud to be regulated because it's important to be under a certain framework where you can give your stakeholders, whether it is your investors, your partners, or even team, a fully compliant framework in terms of execution, establishment, and running the company. I can go on and on, honestly, but it's something we think about all the time, and we try to connect between business and risk in a way where we can maximize opportunity, yet maintain those controls in place to balance between the two.
No, absolutely. And as you say, it's very important to be able to have a business outlook, but whilst maintaining a governance within your operating model. And Sonia, I guess same question to you in terms of how you would look at managing the risk on the investments that you take place.
Absolutely. So we're very similar to Abdullah in the way we look at our companies. We both invest into early stage tech companies. So there is a significant, it's inherently very risky as it is, but we have to put processes in place to help manage that risk. And we, as Abdullah said, we use something very similar to what Alessandro mentioned before with the scorecards and how we look at the risk and how we manage that risk. You're looking at operational risk, you're looking at legal risk, you're looking at financial risk, you're looking at commercial risk, and then you have to tie it together as a whole to see how that manages amongst your portfolio risk. So what we spent so I know Abdullah mentioned a lot about the way we look at the individual companies. We also spend a lot of time on the portfolio level managing the risk at a portfolio level. So looking how each company fits in at the portfolio level. Are we diversifying our assets across subsectors within where we're looking at? Are we diversifying across markets? So we spend quite a lot of time at the portfolio level managing that risk because it's very commonly in VC everyone says you don't make one big bet, you make many bets, and those bets have to outweigh each other. So a lot of it is at the portfolio level as well. But in the individual company level, there's many ways we can look to mitigate risk, and that is especially looking at the teams that we're working on, working with, helps to manage a lot of the risk that you have with execution risk. And we have been investors in VC for a long time. Ventrue originally started as a global investor, and now have seen the opportunity locally and have come back to the region and started investing heavily in the region. Programs like what Jada has provided in providing capital to the region has completely changed the risk profile of the region. Availability of capital in this region has caused the quality of these tech companies to increase significantly. So all the objectives that these programs have had in place when they came in are absolutely doing their job. We see consultants, bankers, lawyers leaving very good fancy jobs to create tech companies and solve problems that are inefficiencies in the market that we see right now by using tech. And having that availability of capital, so knowing that these companies knowing that they quit their fancy jobs in order to build companies and help us evolve and innovate within our ecosystem in the MENA region has been invaluable. So that has mitigated risk on the operational side, because we have better founders and better talent in amongst the pool in which we're investing in.
You make a very important point with the number of human capital being moved and directed into the venture space. And on that point, actually, so can I ask you a further question? If there are any types of venture capital investments that you would deem as being too risky, despite potentially having a positive appraisal or positive view?
Well, we're fintech investors, so there's a significant amount of regulatory risk, and that to us is quite poor. So anything that's not, compliant or within regulations, that is too risky for us, absolutely. And you see that, originally, like early tech companies were kind of breaking the mold and trying to, break regulations and, going almost against regulations and still getting funding. Now that to us is kind of a line we have to make sure we're within regulatory laws, and to make sure we're not, that's a bit too risky for us, but hasn't always been the case for earlier VC investors.
Understood.
Yeah.
And same question to you, Abdullah.
Yeah, I would agree in regulatory risk. I think that's definitely real. I would say, I mean, it depends really, because sometimes when you look at the past, and especially when we look at our own investments that really worked, a lot of times in the beginning and during that journey, before you realize that they worked and they returned for you, usually one would do even the fund 3 times. You realize that a lot of times you will see a lot of risks during that journey, but later on you will realize certain dynamics happen, whether internally in the company or externally in the market, that eliminate or mitigate those risks. So you got to accept a lot of the risks in place, and some of them might be either inherent within the company or even with the market. I think what differentiates knowing which risk you can take and which risk you cannot is building that experience. And honestly, I think that's why in our game, especially private capital, track record is paramount. And I think Jada, I'm sure, can speak a lot of that, given that they are a leading allocator in the market. Track record builds that resilience. And honestly, I remember one of the things that actually we liked about Jada's due diligence was a really good question, was speaking about the failures that you had as an investor before establishing the investment, that you're asking for an allocation from Jada. And I think that question always rings a bell in my head, because it was a really good question, but very telling when you really reflect and look back. And you realize a lot of companies initially, you thought low risk, they have money, they have revenue, and they're doing okay in a market where relatively doesn't require much regulation. But then you realize later on, you learn things that you were not aware later on. So you got to keep that room open. And then other deals that you thought were, moonshot, relatively speaking, that really works at the end. So I think from time to time, reflecting and questioning a lot of the things in place is important, because it's an evolving process. So is there risk that is too much to take on? I think it depends on the deal, depends on the asset class that you're dealing with, and depends on timing. Because sometimes regulatory risk can be real, but if regulation is going to open up around the corner, then timing plays a big factor in mitigating that risk.
Understood. And before we open up the questions to the participants, maybe we've got time for a couple of minutes for one additional question. We talk about regulation, we talk about new venture capitals potentially entering the market. If we zoom in a little bit more specifically, are there any specific financial indicators that you would monitor or refer to as part of your assessments as well? What do you really focus on, Abdullah? Financial indicators.
Yeah, honestly, at the portfolio level, we try to look at the main ones, right? Revenue, traction, and then company specific or industry specific metrics. If it's a SaaS company, then you would look at recurring revenue, whether annual or monthly. So those are the basic ones. And honestly, with the abundance of information on the web now, you can get a lot of this stuff and know them and teach them to your team. So that's at the portfolio level. So depending on the company, then you have the basic ones like revenue and others. And then at the fund level, I would say always start with IRR. And this is important for us. I know there are other important metrics, but in the beginning, it's not that indicative, but eventually you got to look at it. And that factors in time. Sometimes, and one of the good discussions that we have or we had recently is when does a a follow-on investment becomes too expensive, right? And you put a follow-on at year number 4 or 5, or even at an extension period, and it doesn't give you that VC return. You bring down your IRR, you bring down your cash multiple, and it affects that. And then after that comes the total value to paid in capital, and then eventually at the harvesting period, you look at DBIs and how's that shaping up. So I would say the basic ones, but you gotta know when to kick them in. You gotta know when to look at them, because in the beginning, typically in private equity and venture capital, a lot of these metrics get a big hit in the first couple of years because of the fees, because of all these costs that are set up in the beginning. But eventually, they should start ramping up. And if you get really, and I want to use the word lucky, because you really need to be lucky at the end of the day. A lot of things you cannot control. If things play in and work out, eventually you have to see these numbers start to come up, and you have to see your returns come to fruition eventually as you harvest these returns.
That's great, thank you. And Sonia, we've got a couple of minutes. Do you have a similar viewpoint, or do you differ in terms of the financial numbers that you would look at and financial statistics?
Absolutely. So just adding to what Abdullah said, we monitor all the same metrics that he mentioned there, but we spend a lot of time looking at the margins of the business, because you can have a business that will operate forever, growing top line dollar amounts and really not have anything at the bottom line. So for us, we spend a lot of time with margins, like how can you increase take rates, increase margins, and that for us that's an important factor when we look at the companies on an individual level. When you look at financial indicators as an industry as a whole, it's not VC is not directly highly correlated to we monitor financial markets. We monitor what's going on a macro level to see what's going to impact our companies overall. We definitely, there's a lag in finance and public markets to what you'll see pop down to the individual companies, because they just mainly there's availability of capital. But finance, some indicators that we look at is like availability of talent and cost of talent, because that directly impacts our companies and their ability to grow and ability to seek good talent, and their burn and the cost for them. So those are the kind of macro indicators that we look at as well.
That's brilliant. Thank you so much, Sonia and Abdullah, for your time and your insights. That's really much appreciated. I think we've got a couple of minutes left for Q&A, which is open to the participants. And I can see a couple of questions already come in. The first one, it looks like this is going to go to you, Alessandro. Just see what's coming through. Okay, Alessandro. So a question here is, what are the challenges of applying MSCI borrower risk model on a new asset class like Saudi Arabian venture capital and private equity? If you could answer that perhaps in a couple of minutes.
Yeah, I think the challenge is also, I think Sammy gave some brief description. The challenge is that the software relies also on public proxies, and for instance, for Saudi Arabia, for some specific industries, probably there is not so much availability of companies, so the sample is very limited, so they can provide some distortion. And also when there is the estimate of industry and estimate of private factors, not being specific private factors related to the Middle East, we always have to assess what is the venture capital market, which is more closely to Saudi Arabia and the GCC. We should look more at Europe, we should look at Asia, AUS is more mature. So that's it is often internal discussion, what is the best proxy to use, given that venture capital in the region, so far there is not much data. Also even on listed companies, it's not so well diversified that we can have robust information. So most of the time we need to provide some adjustment to take probably information from market that are more diversified and adding some discount or premium based on the fact that we are in the Middle East, which is a bit different type of structure from what we have in the US and Europe.
Brilliant. Thank you, Alessandro. And we've been given a question which will go to the panelists. And the question is, how do you manage the risk associated with blockchain-enabled technologies such as crypto and NFTs with the lack of regulatory framework in many of these jurisdictions? Perhaps, Sonia, if you want to try and answer that within a minute, and we can give 1 minute to Abdullah as well afterwards.
We've concentrated our efforts in that sector on infrastructure as opposed to actual NFTs or currencies. So exchanges that are operating within the regulatory frame, the local regulatory framework, and the infrastructure around it, as opposed to the more riskier digital assets.
Yeah, I agree. We do the same thing. So we invested before in a crypto exchange, and we usually do it at an infrastructure basis, and we do what mainly we focus on licensed companies and entities. And honestly, usually whenever we do that, we don't overexpose, because then they still, if you're regulated in Bahrain or UAE, you're still selling in Saudi and elsewhere. So still things might go the wrong direction. So whatever happens, you have to be not overexposed either way, even if you kind of protect yourself. So we kind of do that, but fully agree with Sonia on that front.
Oh, fantastic. Now, thank you all very, very much. We've reached the top of the hour now. So I'd just like to say thank you to Adel, thank you, Abdullah, Sonia, Alessandro, and the speakers from MSCI, Sam, for all of your time, and most importantly to the participants who've taken part in this webinar. I hope it's been useful for everyone concerned, and we certainly look forward to meeting again and presenting again, hopefully in the future, inshallah.
Thank you.
Thank you.